Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, we're finally back here on YouTube. It's been a few weeks and today we're going to be looking at our proxy for the S&P 500, the SPY, the PCC, the VIX, and we're also going to take a few minutes today to just look at a few macro points that I want to make as well about the US economy. But first, okay, I just wanted to take a moment of your time to talk about the Green Star Trading Patreon and why I think you should consider joining. So, one of the things I really want to get across, and has been brought up several times by our members, is this is not a expensive subscription service. Okay, you can sign up for 10 quid a month at tier 2 and you can leave the next month if you want. During that month, you will get the weekly updates for the major moving markets of the gold, SPY and Bitcoin. I occasionally change out gold for oil or something, but you get a market update each week. You get access to all of the previous educational content I've ever produced, including the Elliott Wave series. You get access to a public Discord with multiple channels where you can discuss things with our other members. You get access to live streams where I cover the exact assets you want me to look at. There's a specific channel for you to make those requests. Sometimes these live streams are 2 hours, 3 hours, sometimes even 4 hours long. And that is just for £10 a month. And like I said, you're not obligated to stay. If you want that and a little bit more, you can join for £15 a month, get everything I've previously mentioned, plus a dedicated series called Watchlist, where I look at the specific assets I'm currently interested in and go into great detail on the analysis of those assets. You also get access to the monthly dividend calendar and stock rating system. So I think it's a bargain, guys, and like I said, my whole mission with this channel over the last few years is to just try and help people get their heads into trading, into investing in a way that's affordable, isn't going to break the bank, isn't going to screw anyone over, and just try and push them in the right direction to help them develop their own skills and their own interests. You know, I'm not a guru trying to market £1,000 program or any nonsense like that. So it's totally up to you. There's a link in the description box at the bottom of every video. And if you want to sign up, feel free. But it is the best way to get regular updates, the best way to get access to all of the benefits I just mentioned, and to all the extra content that isn't available here on YouTube. So if you do choose to sign up, be aware there is a free option, but this is a nonsense option. It's something that Patreon forces upon all of us creators, and it will give you access to absolutely zip. There are 3 tiers, tier 1, tier 2 and tier 3. Tier 1 is just your opportunity to make a donation directly to Green Star Trading to help me continue my work on YouTube, but you will receive no further benefits after that other than knowing that you're a wonderful person and you have my thanks. If you want to gain something from it, then should consider joining tier 2 or tier 3, the aforementioned £10 a month or £15 a month. Alright guys, thank you very much for your time. Now let's get back to the video. Okay, we're back. So apologies for my absence the last couple of weeks on YouTube. Been extremely busy. It was a half-term school holiday last week and we decided to declutter the house, and after 12 years in the same place and 2 kids, there was a lot to declutter. So I've been very busy. Prioritise updating the patrons with a weekly update for the SPY, Gold and Bitcoin, and also putting out content covering all of the requests that people put for the assets they want me to look at. And I haven't had a chance really to get back to YouTube until now. So we're going to start by covering the SPY. Now, we're going to start with classical analysis, then we're going to come into the Elliott Wave count, then we're going to talk about a few little macro points I want to make as well, with also a quick look at the PCC and the VIX, but we're going to try and get through this as smoothly as possible. So first things first, let's turn off the Elliott Wave count, daily time frame, bring up our exponential moving averages. So we had a zigzag down. Zigzag through the 250 exponential moving average, which is synonymous for completing a larger wave degree correction whenever we break the 250. We did it here, smaller one here, but we did breach it, larger one here, right? If you go back in time, that's roughly true. Smaller wave degrees trend above the 10, larger ones come and trend above the 60, and bigger ones trend above the 250, and bigger ones still break it. From there, we've had a V-shaped recovery. Excuse me, bit of a frog in the throat today. Most impressive V-shaped recovery I've seen since COVID. Yeah, rocket out of here like a goddamn rocket ship. Massive volume at the lows, and we now have all major moving averages pointing up with a big bullish picture, all of them above the 250 with the price above all of them. Right, so nice bullish look. We saw pretty extreme levels on the indicators here. We came right down to oversold conditions. The little red line here at 17.58 on the daily time frame shows that we haven't been here since COVID, so very oversold. And we came rocketing right back up to overbought conditions on the RSI, levels on the RSI we haven't seen since July 2024. The OBV is in a clear upward trend of higher highs and higher lows and continues to maintain it. The MACD has seen the greatest resurgence or greatest surge of momentum, with the average well above the signal line and above the zero bound. The strongest momentum we've seen since the bounce of the 2020 COVID again. So really strong momentum, V-shaped bounce, that's what you get. However, into the recent highs, we're starting to show some weakness. Now, no confirmed bearish divergence yet, as there is no bearish pivot in place. No daily bearish engulfing candle, for example. But either way, we've had the average cross river signal line on the daily time frame. We've had some red bars build up on the histogram here, showing some bearish momentum starting to build. We've had divergence between highs and lower highs in the RSI and a flattening of the OBV. All of this points towards this high being here, being generally weaker than this one here. Therefore, this is approaching the end of a bullish trend, or is a corrective structure. It's one or the other. Okay, that is the classical analysis. So let's come in now and have a look at the Elliott Wave picture, shall we? With the primary count, come down to the hourly time frame, focusing off of the low, off of the 7th of April. So I recently shared a video with my patrons on the Discord where I showed a portfolio of mine, stocks portfolio based on recent acquisitions, and I showed that I basically brought the living hell out of this low. It's not a brag or a boast. The reason I bring it up is I'm going to talk about it later in this video when we look at some macro graphs about the narrative that formed during this correction and how it was all complete bullshit. But unfortunately, we live in an environment of pervasive fear and people believe it and they miss opportunities as a result. I am not some kind of smart-ass institutional trader. I'm a retail trader just like the rest of you, but I've just been doing this long enough to be able to smell the BS when it's around and to take advantage of the pullbacks when they occur. The old man was right. You buy when others are fearful and you sell when others are greedy. It's a simple philosophy, but that doesn't mean it's easy. Right? Climbing Mount Everest is simple. You just keep going up till you get to the summit. It is not easy. People often conflate simple for easy, but they are not the same thing. But either way, we'll come and talk about that later. Either way, here we are on the hourly time frame, and we've come flying up out of this low, and I think this is a leading contracting diagonal. Following the new Elliott Wave rules of the latest additional update, I think it's 12th edition, 12th or 13th now. But either way, the 3 no longer has to be shorter than the 1 in the new rule set, but the 4 still has to be shorter than the 2, which it is, and the 5 must be shorter than the 3, which puts the limit at 662.71, which breaks down as a series of zigzags where we have ABC, 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 so on and so forth, until we get into this ABC here. We have gone with the current price above the top of the wave 3, which is the minimum requirement to complete the next zigzag, so the 5th could be in, and now it's going to break down, or we continue to push higher, right? And this is actually 1 and 2, 3, 4, 5, A, B, C, and we get a blow off 5th, which goes over the 1-3 trend line, which was called a throw over in Elliott Wave terms. And the contracting leading diagonal should form a rising wedge structure based on 2 trend lines, one placed on the 1 and the 3 and one placed on the 2 and the 4, and they should converge in time and price. And that is what's happening. So that's generally how I see things. If we break down now and we take out the pivot here at 575.59, that's the bottom of the wave 4 taken out, we can assume that the structure is now complete with the wave 5 up here, and we are now put a larger 1 here, and we are now retracing into a 2. So prepare yourself, if it does break down, for all of the BS narrative to come back. Trump this, Trump that, tariff this, tariff that, Putin this, Ukraine that. Never-ending bullshit designed to make you sell your stocks to the institutions for less. And that's all it is. So just prepare for that, because it might be on the way. Or we have some kind of massive breakout and we go rocketing higher and we have to come back to the drawing board. So are there any other ideas? Yes, I said that it's either a 5th wave because it's eliciting weakness, right, on the MACD and the RSI, or it's corrective. The corrective way of looking at it would be we've already completed a leading contracting diagonal and it was much more traditional in its form. Okay, we had the throw over of the fifth, so let me just delete this fib as it's making it a bit confusing. But essentially what we got here was 1, 2, 3, 4, 5 into 1. This was A, this is a corrected B, eliciting that weakness that we often see in a B wave, and now we're going to come down in a C, and we're going to get quite a shallow 2 because it's going to be a flat structure, and then we're going to resume the rally. Okay, and that is essentially my alternate bullish count. I know the primary is bullish as well, but that's my alternative explanation for it. Then we have bearish alternate. Right, now pretty low probability this. I had it as a W down to here, A, B, C or W, X, Y into an X. The problem is that X has continued to elevate higher and higher. From here, sorry, wrong tool, it came up to here, then it came up to here, then it came up to here, and now it's here. So for a double zigzag structure, which is supposed to be a sharp pattern, zigzag down, zigzag back, zigzag down, it's not behaving like a sharp at all. Yeah, at the end of the day, we are what we are, like I said, like 2.5% away from the all-time high. Pretty bloody deep retracement. 81% not quite, or 89% I should say, sorry, which is a fib number I use for the retracement of the B wave within a regular flat pattern. I can't label it B yet. I've got it in orange because it's bloody close, but it's just not quite there. Because I believe that at this point, if you're going to be bearish, the best explanation is the flat pattern, which should elicit the more common breakout to new all-time highs. Breakout to new all-time highs, there's your B wave, 5 waves down to a new low. So I've labelled it orange at the moment, but I have to keep it X as the primary, as the, not primary, but you know, the main bearish count, because we haven't met the requirements for a flat pattern yet. But I think it's pretty unlikely either way, to be honest with you. This looks clearly corrective 3 waves, this looks clearly motive, so this looks like a complete correction. This looks like a motive structure. Moving off to new all-time highs next seems the most likely thing to do. We won't necessarily do it before we make that wave 2 correction, but I think that's where we're going over the longer term. I think that's where we are off to new all-time highs given enough time. But that's not an insight, is it? It's been true for 150 years. Okay, so that's not exactly an insight. You don't need a brain to figure that one out. But either way, that's the bearish count. So to sum up quickly, primary suggests a contracting leading diagonal, which is yet to finish, but could finish at any moment. The alternative is a completed diagonal. We've done the A wave, the B wave, and we're in the C, about to enter the C wave of a flat correction at wave 2. Or it's bearish, and we are more likely now, I feel, to seek out a new all-time high for a B wave than we are to collapse from here, because any collapse from here would support the bullish counts better, as we have failed to reach the requirements for a B wave within a flat pattern. And as I've already pointed out, the idea of a double zigzag coming so deep in the X wave is extremely unlikely. X waves tend to be shallow, brief, and over much more quickly. Not always the case, but most often is. So there you go, that's the Elliott Wave counts, and I don't think we need to make it any more complicated than that. In the shorter term, we're looking for a pivot through 575 spot 59 to confirm the completion of this bullish count, or the extension of the C wave within the alternate. Any move above 662 spot 71 requires either a larger correction to have completed here or a recount of what's going on. I haven't got a clue what that is at the moment. We'll have to deal with that if and when it happens. There we go. So then let's come in now and have a look at the PCC. So we are over time heading back towards extreme complacency and bullishness, right? I used the 60 exponential moving average and the 250 exponential moving average to soften things down over time, because if you don't, it's pretty wild. It's back and forth, back and forth, back and forth. It looks like this. Okay, which is pretty nuts, and there's no use to anybody, is it? So we can use a series of exponential moving averages to smooth it down, and we can add in a whole bunch. For example, we could add in a 10 here, which brings us on the shorter time frame, whipsaw into extreme fear, whipsaw down into extreme complacency and bullishness. But over time we see pretty clear market cycles from extreme fear and bearishness to long sustained bullish rallies in the stock market, back to extreme fear, long sustained bullish rallies in the market, back to extreme bullishness, I should say, back to extreme fear here, bullishness here, long sustained rallies in the stock market, sorry, long sell-offs, and then long sustained rallies in the stock market. Since the lows of October 23, we've been in one of those sustained rallies in the stock market. We're heading back towards extreme bullishness and complacency. Longer term, when we get down here, we will be approaching macro tops in the market again and looking for an eventual breakdown. Then we will move all the way back to extreme fear and we'll be looking for macro lows. These lines, these yellow vertical lines, mark the macro lows, the buying opportunities which come along. Okay? And they happen all the time. So if we take the most recent spike in April 25 there, and we just pop that there on the chart. So that's, what's that? That's around 22nd of April. Come back to the SPY. Let's find the 22nd of April. That was here. Now, we know what this is called if you're a member of the Patreon, you're a member of the Discord. Swing into a high, swing into a high low. This is called the STS, standard trade setup, and it would have been the perfect low to enter this trend. Okay? The market tends to tell you generally when there's a low about to be in place, and it's when people are shitting themselves and everyone's getting scared. Right, that tends to be the time to buy. The old man was right. I know I keep saying it. But obviously larger time frame corrections like this low on the 30th, around the 30th of October. Come back to, where was that? And that was 30th of October 2023, wasn't it? We're going to have to zoom out to the day time frame for this one. 30th of October 2023. Here it is. That was the last extreme reading we had on the PCC, and what do you notice? Once again, guys, it's the first move up off of the low and the first pull back to a higher low. What we call the standard trade setup, but on a larger time frame. Right, perfect opportunity to enter this trend. So it's just time and time again when people get scared, larger wave degree, smaller wave degree, people get scared, buying opportunity, right? And now I'm beating you over the head with it, but it's just the way it is. So now let's move on and have a look at the VIX, and we'll see the exact same again. So I mark all of the events which go above the panic line, which I consider to be 50. You can nitpick if you want, but you get above the panic line and people start to lose their fucking minds, right? And it's normally an extremely good buying opportunity. So we had here on the, where was it? The 5th of August 2024. Where was that? Oops, daisy. 2025. There you go. 5th of August 2024 is here. That was, what did we call that? We called that the 2024 recession fear spike. Right, 1st of August 2024, I should say. Excuse me. The 5th of August. So it's actually down a little bit. It's about there. Right. This marked the coming low, and then we had a sustained rally to the high from that point. If we look at the next one, we've got the tariff trade war panic, which was a spike above the panic line at 60, lower than the 2024 recession fear line, and that was the 7th of April. Let's come down to the day time frame just to make sure, or up to the day time frame just to make sure I'm getting this right. Tuesday, 8th of April 2025. What do you know? Here's the 8th of April. The exact low. Between the PCP on the spike, which you could attract on the 20th, a 20 exponential moving average rather than the 60 would give you more accuracy. Or here on the VIX, we can see that we've marked two lows. We've marked the absolute low with the VIX, and then we've marked the STS as well. Two perfect entry points for this ensuing rally. And we can see here, you know, with that spike on 60, that's the tariff trade war panic. Now, if you could just take your mind back to this moment, okay, and remember what was going on in the media, what was happening in the narrative that you were being fed day in, day out, right? You were being fed fear. Fear was the buying opportunity. So there you go, guys. That is basically the VIX. VIX is now suppressed again, back below 20, trundling around. It was in this upward trend. I'm going to just adjust and say until we get a significant break of that rising trend line, I'm going to assume that generally there's a volatility bid. Where you just got gradual volatility building up over the longer term in the stock market here. But if that breaks down significantly, we've seen that trend break down before, like we did here. Then that just means more bullishness, really, and more complacency. But we're suppressed at the moment, back below this long-term downward trend line. We've had our little fear moment. That was a buying opportunity. No doubt another spike will come when this trend ends, and we'll see what we get then. But it will probably be another buying opportunity as well. Alright, so that's enough about PCC, VIX, SPY, and how they line up with one another. But now let's come over and have a look at some macro little charts I want to share with you, to get home the point about the toxicity of the narrative. So I'm going to go off on a little bit of a rant here. First thing I want to start off by saying is that in my experience, I've mentioned before how each of these rallies off of these lows is more hated than prior ones I've seen. And I've been here for a fair few years, right? And I've got a theory about why that is. So I think with the ever-increasing access to the internet, the amount of opinion and media and outlets for it and formats for it that are available, myself included, I have a YouTube channel, I share my opinion, has now reached just levels of such saturation that it's almost impossible to escape the drive of the narrative and the algorithm towards what gets the clicks, what gets the attention, what gets the hits, and that's fear, anger, hatred. It's all the negative emotions, right? That's just what does it. That and sex, of course. But either way, I digress. The point is, we live in a media-driven, fear-dominant, fear-saturated environment. And if you go through life absorbing all of this media, which is completely weighted towards the negative, you will end up mentally ill on some level. My own philosophy as I've gotten older, I have a wife and children to look after, to provide for. I focus on the incremental improvements I can make to my own life and theirs on a daily basis, and I try to shut out the noise, because honestly the noise is not balanced. You are not getting 50% good and positivity and 50% bad and negativity. You are just getting 100% negativity or 95% negativity. If you go through life on X, what used to be called Twitter, other social media, YouTube, the news, and you just absorb all of this social media output and you absorb all of this media output, you're going to end up with a completely incorrect view of the world. You're going to end up with a completely skewed bullshit opinion of the world, which is that it's all black, it's all negative, it's all despair, it's an endless pit of suffering, and it's all bad. And that's completely and utterly wrong. And you could disagree, but if you are disagreeing, ask yourself why you're disagreeing, right? If you believe it is all of those things, maybe you've fallen for the narrative, right? Because being alive is an insane privilege and an unbelievable luxury, especially if you're lucky enough to live in the Western world like a lot of us do, all right? And we live in an environment now where fear sells, right? More than anything else. Fear and sex. Fear mainly, in terms of media, sells. And that fear is economic collapse, Trump this, Trump that, tariff this, tariff that, Putin this, Putin that, war this, war that, nuclear weapons this, nuclear weapons that, environmental collapse, societal breakdown, family breakdown, and it's just never ending fear narratives thrown in your face non-stop. And it's toxic, and it's a pollutant which pollutes humanity, I feel. And the problem is we've accepted it, and this is all just my opinion, we've accepted it as a baseline for our reality, and therefore anyone who pushes back against it is considered naive or not realistic. But what we've actually done is we've replaced realism for cynicism, and now we think cynicism is reflective of reality, and it's not. You are literally just absorbing negative all the time, and that comes back out when you speak. That comes back out in how you think. The world is not 95% negative, it's 50-50. And the reason I'm talking about this is exactly why people hate these rallies, because they missed the lows. From the point of view of traders and investors and people who want to get into the market, right? They bought the narrative, they bought the bullshit, they bought the negativity, they bought the doomsday, all the crap, and they missed the opportunity. And now they hate themselves for missing the opportunity. We say we hate their rally, but really they hate themselves for missing it. Okay, I know, I've been there. I'm not lecturing. I've been there, done that. Got it right this time. Shared it with my patrons. So they got it right this time. Got it right before. Shared that as well. But I've got it wrong before, because we are all human and we are all susceptible to this noise. Right? But ignorance is bliss. I'm not saying be completely ignorant. I'm just saying, what is the news? And how much of it do you really need? Right? Because I tell you what the news is. Here's a bunch of horrible, heinous, disgusting shit which makes you depressed and you can't do anything about it. Wasn't that wonderful to engage in? Maybe not. Maybe you should just ignore it. Right? Because it's just noise. Focus on people's reaction to it. Don't let yourself be controlled by it. Alright, like I said, the difference between simple and easy. Climbing Everest is simple. It's not easy. Right, don't conflate the two. Buying when people are fearful is simple. It is not easy, but we are going to endeavour to make it easy going forward. We can use the tools like the VIX, the PCC. We can use basic support and resistance. We can use Fibonacci levels. We can use Elliott Wave. We can use a whole bunch of other things and evidence and oversold conditions in the RSI, the MACD, and la 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 la. And we can use all of this to say that looks like an excellent buying opportunity, right? But when it arrives, you've got to pull the fucking trigger. Okay? And the only way you're going to do that is if you're not overwhelmed with all this negative bullshit. Right? You have to believe that the world isn't just all, doomsday nonsense, because it's not. Now, anyway, I could go off and on about how I feel it's too late for some people. We seem to have raised a generation of doomers, they call them nowadays, people who are incapable of realising that they're trapped in a lie. But we'll move on now and we'll go and have a look at these macro charts. So there's your little rant. I'll timestamp that, saying Tom absolutely going off on one. Okay then, so don't worry, this is still a technical analysis channel. I haven't gone all crazy and we're going to talk about all emotive arguments and stuff all the time. This was a one-off and I'm just going to leave it at this. I just wanted to share my thoughts about, market lows, market highs, and paying too much attention, too much respect to media narratives rather than data. So on that point, let's look at some data, shall we? The market priced in the worst case scenario after Trump announced his Liberation Day tariffs and then quickly realised afterwards that it wasn't the worst case scenario. It never is with that man. If you were here back in 2016 when he was last elected, this is the playbook. You ruffle people's feathers, you shake them up to try and get a rise out of them. Those who are stupid rise to the bait, those who are not do not. Unfortunately, most politicians are pretty stupid and they rise to the bait immediately, and Trump basically gets what he wants. He gets the reaction he's looking for, right? And with those responses, we have multiple options available to us, or to him at that point. He could bring people to the negotiating table, he can make deals, like he has done recently with the UK, with a trade deal, or he can postpone the tariffs for 90 days or 120 days. He can introduce an emergency one, or he can remove it, and, it's all just, theatre. It's not the narrative that's driving this rally. It's the same stuff that drives every rally. What is that then? Let's look. So M2 money supply. Now let's give Raoul Pal his credit. He's gone on about this a lot longer than most other people. He's mainly applied it to Bitcoin because that's that brings in the clicks, and I don't blame him for it. But his charts have been circulating the internet all over the place, from Real Vision, I think it is. Not a subscriber myself, not shilling his channel, just pointing it out, giving credit where credit's due. Right, everyone's been citing M2. I've been talking about it for months as well, besides the point. So M2's been increasing and continues to do so and continues to accelerate. This is M2 in the US, by the way. Global M2 has increased as well, but some of that is the result of foreign exchange. Obviously the dollar's weakened and other currencies have strengthened against it. This helps increase overall liquidity. So how important is M2 if it's not the narratives that drive markets? It's data, it's reality, right? So let's have a look how important it is. Let's come all the way out to the monthly time frame. The craziest, most bullish looking candle ever. But either way, let's come out to the monthly time frame. And let's stick M2 on the chart. This indicator has an offset to it. You can add or subtract to it. It was created by one of our own users. And this is all the evidence you're ever going to need about what really drives markets. Okay, what really drives the stock market. And it isn't the fear of whatever the news is reporting during this, or the fear of COVID here, or the fear of tariffs here, or double dip recession back here. It's not. What drives markets is liquidity. Okay, end of story. So this is another reason to ignore the narrative. Now, what other things should we be paying attention to? Well, in my opinion, after M2, the most important cyclical impact is the ISM report on business for manufacturing. This is the ISM index. It's called the US Business Confidence, but either way, this is the ISM, and this is the 4-year business cycle. So here's 2016 to 2020, here's 2020 to 2024. The next move in the business cycle should be back above 50 and a sustained move higher. It's lagging. Why is it lagging? Well, it's not lagging because of sticky inflation, and it's not lagging because of Trump, because this has been bottoming since 2023. It's not lagging because of tariffs. It's not lagging because of media narratives. It's lagging because the Fed are a bunch of twerps. It's not inflation that's sticky. Inflation is back to where it fucking was. Go and look at the CPI. Go and look at previous years where it spiked above 2.8, where it spiked above 3.4, like in years prior to COVID. Right, CPI is back to where it was, and they use core PCE anyway, and that's back to basically where it was. Inflation isn't sticky. The Fed's fucking policy is sticky. The Fed's rates are sticky, and it's hurting the economy. It's stifling refinancing of debt, the rolling over of debt. It's stifling access to easy credit. It's stifling growth because we need to borrow in order to grow. The business cycle will get moving once liquidity in the form of lower rates and higher financing comes on tap. M2 feeds into the stock market because it's not infrastructural. It's not based on actual real economics. It's based on availability of buying financial assets, right? Liquidity. Okay, and a lot of that is tech based anyway, so, and growth based, right? It's chasing the gainers, it's chasing the winners, and as long as there's free money to do it, just as we saw during COVID with the entire economy shut down, that's all that matters. If we want business to expand, we need easier access to credit. I think it's coming. It's not here yet, but I do think it's coming. I think with yields continuing to drop, yes, they've been peaky, they've been sticky, but they are going to come down. I feel the Fed will follow. The inflation argument is dying. And on that note, let's look at the Fed's preferred metric for inflation, which is US Core PCE Price Index. Okay, we got a lower reading than most people were expecting, as we did with the CPI for April, and we will for May as well. I'm certain of it. Well, I'm not certain, but I'm pretty positive. So there may be some inflation to show up later in the year due to global trade, due to tariffs, but I genuinely think that's been massively overestimated. Post-Liberation Day in April, I was listening to people saying, that's it, 10% inflation by the end of the year. Absolute fucking nonsense. Right? Just nonsense. Fear-mongering again. It's just not going to happen, guys. The deflationary pressures in the economy are immense, and there's arguments, I don't really understand a lot of them, regarding AI and stuff. I appreciate the automation side of things, but I don't really understand the AI side. But I've had people far brighter than me who I know who work in the industry assure me that it's going to be massively deflationary upon the economy. So it strikes me that inflation is not the concern here. What's the concern is the Fed's cowardice towards lighting the fuse under this economy, taking the top off the bottle. I mean, they're just scared, and they're playing it too bloody safe, in my opinion. Now, obviously, that's my opinion because I want everything to go to the moon. But either way, I'm just pointing out that even by their own favourite metric, we're back where we started almost. I know it was lower here coming out of actual 2020, right? Before we had the massive inflation here, we had the deflationary impact first. But longer term, we're roughly back to where we are. And obsessing over hitting exactly 2% is just silly. It's just silly. All right, so another thing I want to point out. So we talked about the ISM, we talked about money supply, we talked about PCE. So what about this chart? This is US foreign bond investment. All of this stuff comes from tradingeconomics.com via different government departments, such as the Fed or Department of the Treasury. And what you see here is the natural whipsawing above and below zero of the net positions for the foreign purchase of US debt. So buying US treasuries. And if you were to listen to the media on any given day, you would get the impression that this chart should start in the top left and descend to the bottom right over any given time frame, and that the entire globe is dumping US debt. Once again, complete and utter fucking bullshit. Alright, it oscillates back and forth. There is a good time to buy US debt and to load up on it. Strangely enough, it has a pretty nice. It has a correlation, not 1-to-1, but it has a correlation with the strength of the US dollar. There's a good time to buy lots of dollar-denominated debt, and there's a bad time to buy it. The impact of rates has a significant impact, but my point is, it oscillates. It oscillates over time. It drops, it goes back up, it drops, it goes back up. Right. So we had a bit of a scare going into the end of 2024 and the start of 2025, where the sell-off was the most aggressive we've seen for quite a while, and a lot of people tuned into the narrative that this is it, everyone's dumping their US debt, it's game over. Demand came roaring back in the first 3 months of 2025. It will no doubt probably roll over again since the announcement of all those additional tariffs and stuff. But my point is, when it rolls over, this is a lagging data anyway, but even if you had leading indicators, right, which could tell you what was going to happen other than just everyone freaking out, the media would immediately grab onto it and go, oh, everyone's dumping their debt, it's the end. No, it's not. It's temporary. They'll be back. Because there's no choice. They have to be back. There is no replacement for the US dollar. All right, and the de-dollarists, or whatever you call it, the arguments out there who say, oh, the dollar's going to be replaced by what? By what? Just talking nonsense. 90% of all currency in supply is the dollar. Enormous. Pretty much all global trade is settled in the dollar. 60% of all global debt is dollar denominated. Right, it's at the root of everything. It is the base of everything, and the demand for it is going to remain, and it will continue to oscillate over time. Right. Yes, there are bigger problems down the pipe, but they're problems which are not going to affect the dollar in isolation. Okay. Anyway, so I think that's it really, guys. I just wanted to point out that the things which matter to the markets are the things which matter to the markets, and they always have done, and they always will do. And this is just a warning to stop allowing the BS media bullshit from influencing you, because I'm telling you, outside of your own personal experience that you've had in the market, you can't tell me what any of these events were. You probably can't tell me what that was. You probably can't tell me what that was. You probably can't tell me what that was. Now, if you were there, you could. But this is not just true of my lifetime. We could go back, if we were looking at the SPX, we could go back to the 60s, 70s. If I asked you on the street now, what caused that sell-off in the market, you wouldn't have a fucking clue. All you would know is that it bloody recovered and went higher. Right. So anyway, there you go. Proper ranty video today. I apologise again, but I hope I've got the point across. Stop getting caught up in the narrative. Okay, look at the things which matter. Look at the money supply. Look at the business cycle. Look at global liquidity. Look at rates. Look at inflation. If you want to have a macro opinion, look at those things. Switch off the media. Switch off the news. Stop obsessing over Trump and what he's had for breakfast. Okay, and we'll all just be better off for it. Alright then, guys, take care of yourselves. I'll be back with you as soon as I can. If you're new to the channel and you like what you're seeing, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. And if you want to learn some Elliott Wave stuff for yourself, you can consider joining the Green Star Trading Patreon. There's a link in the description box below, and if you're not following me on Twitter, please do so. I occasionally remember to post. And take care of yourselves and pull your heads in. All the best. Bye bye.